Our next guest says there are some surprising areas to watch for investors interested in the combination of growth visibility and low valuations. Ben Laidler's with us, eToro Global Markets Strategist. Ben, good to be with you. So we were just talking about efficiency and how really the narrative and the priority for so many companies, particularly within large tech and what had been growth, have switched to that narrative. And they seem to be rewarded for that. Is that really what investors are focusing on right now and what they want to hear and what they're really making investment decisions based on?
Yes, I think so. I think the number one question for investors right now is earnings visibility and resilience of earnings, and anything that feeds into that. I mean, the narrative so far, the reason that we are where we are and markets haven't done worse is earnings have really been hanging in there so far. The question is just how much longer can that continue? If the Fed keeps raising interest rates, keeps them high, and the economy ultimately slows, which it will. So I think they're right to be focused on the earnings visibility. I would just maybe add to that, though, valuations are still important and maybe more important right now with bond yields rising.
Ben, as we were mentioning a moment ago on this theme of efficiency, it really is efficiency that drives profitability that a lot of the activist campaigns seem to have been prodding for. And, not even just with Salesforce and even with the Tesla conversations about efficiency. We'd heard this kind of within Disney as well here. So at the end of the day, which companies are best positioned to kind of flip a switch to say, yeah, we can be more efficient, and that can immediately dovetail or translate into profits?
So I think tech is obviously the focus because you have this massive expansion over the last few years, and that is now unwinding a bit. So they clearly have the fat to cut. But I think more broadly, if you look at U.S. companies versus the rest of the world, these margins are still above average. These are not companies that are inefficiently run. If anything, I would argue they've adapted sort of very well to this environment. So I think tech in some ways is the outlier because they do have that cost lever that they can pull pretty aggressively. I'm not sure that lever is going to be as strong in other sectors.
And so does it matter in other sectors, though, in the same way, Ben?
I think there are other drivers in different sectors. So, I mean, we quite like the sort of defensives, the cash flow generative stocks, the things that did well last year and haven't done quite so well this year. I think they're going to come back in favor because we need to keep buying them. That gives them some top-line stability, which maybe other more cyclical sectors don't have. It also gives them pricing power, which allows them to offset the cost increases, which are still coming through, and keep those margins high.
Okay, and so in keeping margins high, it seems like everybody is on the defense to keep their margins high right now. Is there a best protection strategy that investors out there should be looking for in order to kind of best position their own portfolio around companies who are able to best protect their margins?
Yeah, so I think the problem right now is higher bond yields are putting a cap on valuations. So anything that's done with high valuations and particularly those sectors, those disruptive tech sectors, which have done very well over the last few months. I think that's where there's going to be a bit of pressure. And I think there's going to be a refocusing on where is that growth visibility. Who has the margins, who has who's selling those products that we need to sort of keep buying. That's why I think there's going to be a bit of rotation here. If you like, a sort of deja vu trade back into the sort of 2022 winners, the sort of staples, the sort of high dividend yield. But also some surprising places. I mean, we've been talking about airlines recently, which has traditionally been a terrible place to invest. But right now, they're seeing both sort of long demand recovery and they're seeing pricing power because they've managed capacity pretty well.
Ben, it seems like we've had sort of a resetting of the narrative over the last few weeks. We've certainly had a resetting of bond yields, as we were just talking about. Now everything's at around 4%. How long do you think that regime can last? And what is the next catalyst you're looking to potentially reset the market again or change sentiment again?
So we're all data dependent, for better or for worse, from me all the way through to the Fed. So we're all following the data. You're right, we have had a bit of a reset, right? But I still think the narrative is still one of lower inflation, near peaked interest rates. We have had a bit of a reality check. We pushed that back, a month or two, but that still is the narrative. And I still think, the economy is going to gradually slow. Inflation pressures are going to gradually slow. It's no surprise that services and wages is the bit that's sort of lagging that. I still think that's the narrative. That still keeps us invested in stocks. Why we think October was the low. I just think with bond yields where they are, now is the moment for just a little bit more caution, especially if you've been lucky enough to ride those disruptive tech winners over the last few months.
Ben, given the airline kind of appetite that you may have right now, as you were laying it out just a moment ago, what would you look to within the data to say that there is a turning over of that demand, even though they are in their own recoveries right now, and there is the pent-up demand for travelers that continues to be holding up strong right now?
Yeah, I think the positive surprise throughout all of this has been earnings, and what's driven those earnings has been the U.S. consumer. Partly on pent-up savings, but also partly, and we don't talk enough about this, we've had 7 down months of inflation. That is slowly restoring, I think, consumer purchasing power. And I think that's probably going to be the biggest driver. If we avoid recession, that will be it. Consumers getting some of their purchasing power back. And as part of that, they're choosing what to spend the money on, and they're prioritizing things like travel over other things, particularly things like tech hardware, which we all overconsumed on in the pandemic, which is on the flip side why you're seeing some of the weakness you're seeing in tech.
Yeah, most definitely. And the desire for people to get out and about and spend their money on doing things instead of buying things. Ben Laidler, good to talk to you. eToro Global Market Strategist. Have a great weekend, Ben.